Andy, I think we're officially live. Well, everyone, thank you all for joining us today for today's webinar. We're excited to have you all here. No question, we've got a very packed agenda as we dig in a little bit on bridging the gap to that the bridging the gaps that prevent you from getting a complete view of consumers' financial reality. But before we get started, I got to tell you, it's my counterparts today told me I was heartless if I was to just jump right into things. So I figured, why don't we do some logistics? Why don't we do some disclaimers first? We'll give everybody a minute to kind of get situated. But so let me cover a couple of quick topics here before we jump into things. First off, please note that the opinions, estimates, and forecasts presented are for general information use only. Also, today's webinar is being recorded. You'll actually receive an email notification when the recording is available for view. But if some of you would like to access the slides, like to get the information, you're anxious to see them, you can actually access the slides right now by clicking on the resources button at the bottom of your presentation. So it's right in your screen, selecting documents, you'll be able to download those slides right away. And last but not least, of course, we love to have these things very interactive. We absolutely want to hear from you. If y'all have questions, don't hesitate to drop them in the chat pod. We'll try and answer them kind of as we go along. We've got time at the end to answer all the questions as well. Again, we're going to try and cover as much as we can in the time that we have allotted. But we also want to hear back from all of you as well. We got a few polling questions here today, so please keep an eye out, respond. We'd love to hear what's going on in your world. Maybe we'll adapt the conversation a little bit depending on what we're hearing. But again, we got a lot of great stuff to cover, and we appreciate you joining us today. So as we jump into it, a couple of quick things. Let's introduce the crew today. So my name's David Adams. I'm portfolio marketing leader here at Equifax. I'm going to help kind of moderate the show today and have a great conversation with Matt and Puddy. Matt Green, who's here today, Senior Director of Partner of Business Development at MeridianLink. Matt, thank you again for joining us. We really appreciate you taking the time. You and I will have a little bit of a conversation here towards the end, but we want to start with Puddy. Puddy Manaise, SVP of Analytics and Strategy. And Puddy, I got to tell you, every time I hear that title, all I realize is that you're way, way smarter than I am. So I'm so excited and so glad that you're here talking through this and not me. You've got a lot more to cover. You engage our customers very regularly. And so if you're okay with it, look, I'm going to step out of the way and let you kind of run with things for a few minutes as we kind of jump into it.
Thank you, David. Yeah, hopefully the conversation matches up to the title, right? As you set that expectation. But welcome, everybody. Now, as we start today's conversation, I wanted to talk about some of the macroeconomic landscape first, right? It's often we get into the solutioning and the decisioning side of the house, but it's always good to pause and look at what are some of the factors that are influencing what is going on today, right? So to understand why traditional risk decisioning is sometimes falling short, we wanted to get into these macroeconomic factors, and we understand that most lenders are navigating this complex web of headwinds, and it's not always easy. So let's look at these six core dynamics, right? The first one we wanted to chat about is the rates and the consumer cushions. Now, while the aggregate economic indicators appear stable, sticky inflation continues to impact wage gains, right? The pandemic savings have pretty much depleted, and the middle and the lower income households are very vulnerable to sudden financial shocks, right? So we want to make sure that as a lender, and we understand your primary goal is not necessarily to see when delinquencies hit your book, but in identifying which consumers are quietly losing that financial flexibility. So that's one of the first things about that sticky inflation. Then we move into the affordability piece, right? Now, the core goods may show mild deflation, but the non-discretionary expenses such as housing and energy costs, they haven't come down. They're still on a 4% surge. Now, that is tricky, right? Because one, they're non-discretionary, and second, they don't match the overall core goods kind of trajectory. So this creates secondary inflation, which affects the interest rate cuts and also constrains the consumers' budgets. Then we get into other aspects like geopolitical volatility and tech-driven supply shocks. Now, I'll tell you from a geopolitical perspective, this is actually a domain that most institutions have started looking separately. It's become so prominent and it impacts consumers so much that with the instability across different parts of the world, people have started looking at risk even as a separate domain. But here, we're kind of wanted to talk about the supply chains fragmentation, but also the tech-driven supply shocks, right? The AI data center surge and the memory and semiconductor crunch, which like most institutions are headed towards a modernization, but these increases in volatility put a massive strain on the operational IT budgets. Then getting into the labor and the AI automation piece, we're seeing a very distinct low hire, low fire labor market, right? We're not seeing significant movement. Firms are adopting technology and AI and automation to expand output, but they're not necessarily changing the employment structure. They're not bringing in a lot more people to do the work, and they're not letting go of a lot of people. But it is very difficult to judge the stability of this, that what would be the income stability and income trajectory, which makes it harder to navigate this environment. And then lastly, talking about the synthetic fraud piece. Now, this is going to be a prominent topic and is perhaps one of the most urgent needs that we hear in the industry. Now, generative AI has industrialized fraud. Fraudsters are creating these hyper-realistic synthetic identities, and they're doing it at scale, which makes it very difficult for all the lenders and financial institutions to stay ahead of it. And if anybody's kind of relying on static legacy identity checks, it leads to an exposure and eventual losses. So before, though, how we get into how to solve these challenges and what other observations we have, I wanted to pull the audience into the conversation. Let's start with a poll. So what you'll see on your screen is you'll see the first poll question. Please go ahead and select an option that best represents what you're experiencing. Right now, I know a lot of you would be experiencing many things in these, but just take the best shot at what defines the problem that you're seeing predominantly. For example, you might be seeing macro pressures like inflation eroding cash flow or regulatory changes around BNPL and student loan repayments, or emerging trends with AI and innovation or adoption of alternative data. So just take the best guess of what you think the most prominent problem for you is, and then we'll share the results with the broader audience here. I'll give you about 45 seconds to make sure that you have time to put your answers in. The policy gaps is something that is because of emerging trends, et cetera, we're seeing a fair bit as well. Because when you go into trends like credit washing, debt settlement, credit builders, loan stacking, cash flow adoption, those could influence the policy aspect as well. So we'll get into those details. Hopefully, you've had a chance to enter in your choice. Operator, can we start looking at the results, please? Emerging trends is number one, and then macroeconomic pressures is numbers two. Thank you. And in all fairness, as I was saying, this matches what we see across the financial institution network, right? A lot of blind spots are popping up, and it's very difficult for everybody to be confident about how they're overcoming these blind spots. So let's continue on this journey and we'll touch base on more of these, right? So we understand that in all these conversations with different clients and different size customers, that the lending environment is in constant motion. Staying static in your decision flow absolutely isn't an option, right? Otherwise, it's actually an operational risk. So across the industry, we see these six primary triggers that are forcing financial institutions to reevaluate their risk strategy constantly. Right, we talk about the macroeconomic pressures, which you all identified as the second most leading concern that you have. And obviously, in the macroeconomic side, we looked at the interest rate and inflation impact. So obviously, very, very important, directly influences consumer behavior and impacts the bottom line. The second aspect, the regulatory change, student loan repayments and BNPL and shadow debt and other things are continue to be a concern. And a lot of people have asked us, even within BNPL, oh, are you seeing this as incremental debt? Is this debt shifting from one area to another? From a data availability and consumption perspective, what does this mean? So we see that as a constant reason why we're approached on somebody reassessing their risk strategy. The third one, and probably the biggest one, does continue to be the emerging trends, right? And it can be from an innovation perspective on something positive that you're looking for more automation and better models and scores, or it's the blind spots, as I was talking about earlier, that, oh, we don't know how to deal with loan stacking. We're not confident about how to work with credit builders. Debt settlement is becoming an issue. How do we integrate cash flow underwriting into our kind of decision flow and underwriting? So a lot of these emerging trends are popping up. Policy gaps. Now, a lot of times what happens is the top ones are the causality, but where you observe it is the policy gaps and say, oh, my losses are not coming in line with my expectations or forecast, or my revenue is and my margins are really being stretched, and it's difficult to know what is going to be a sustained value that is going to be there for the business on a long-term basis. Then the strategic business changes as well, both from a product landscape perspective, but also mergers, acquisitions, new leadership, the ability to enter new channels or markets. We see a lot of that, which leads to reassessment of how should I go about it, especially from a strategy perspective. And then lastly, the existing integrations, both from a tech infrastructure perspective or cost perspective, are not necessarily ideal, right? A lot of institutions are going through transformation. They're not necessarily happy with the deployment timelines on how fast they can react to the market and change their policies and strategies. Or sometimes it's not cost efficient with the current providers to say, hey, if I do that, my margin is already squeezed and it doesn't necessarily leave much room to make effective changes. So we wanted to, again, take a pause and talk about these things because we understand that we just react to these things, but it's good to pause and put them on paper that risk environment is very tricky and it's important to look at all those aspects. So with this, let's get into a second poll. Right? When evaluating a new applicant, like what is your biggest challenge? Because in the end, for you to get the profitability and returns, you have to continuously look at which aspect is causing you the biggest headache or challenge. So, like we did on the first poll, take your time and please answer what would be your single choice, and it could be all of the above or none of the above as highlighted in section D or E, on what you're seeing the biggest issue to be. We'll wait about 45 seconds, make sure everybody has had an opportunity. Then we'll share the results and proceed. All right, let's look at the results. All of the above, overwhelming at nearly half of the audience choosing all of the above. And in all sincerity, this is the exact reason why we're here, because I fully expected the answer to be all of the above. Because one, all these things are interconnected. Evaluating credit risk, fraud risk, and affordability in isolation leaves major blind spots. And making one decision has a significant influence on the decision, especially as the lineage of decisions goes. So let's look at how layering these insights together brings us total clarity. So here, we want to talk about that for years, our industries looked at credit risk, identity and fraud, and customer affordability as decisions, but often as siloed decisions with different systems, different teams, and different models, right? The consumer has changed. Like fraud has become a lot more sophisticated, and AI is accelerating identity deception. The economic conditions that we talked about earlier remain dynamic, and I don't think ever since pre-COVID we'd had a stable set of economic condition. And then over and above all that, the customer expectations are always around frictionless experience. And with the advancement in AI techniques, their expectations have never been higher. So making these decisions in silos creates like massive blind spots, which increase losses, drive unnecessary declines, and increases friction. So this brings us to the core philosophy of risk decision intelligence. And again, goes exactly in line with you guys identifying, you're all identifying that all of those reasons are a primary concern for you. So here at Equifax, we sought to unify these individual decisions and understand how they influence each other by providing a comprehensive and holistic view of the consumers. So we believe the institutions that have this holistic view will do better because they can understand how these different decisions interact with each other and also observe the overall consumer impact of getting all of these right. So the first component in the risk decision intelligence framework for Equifax is the credit risk fidelity, which looks at more of the payment history and the ability for a client to repay debt, right? So it's not always enough to say how a consumer did in the past and how they did on their trades and debt obligation. We need the most accurate, current, and predictive understanding of their likelihood to pay and with high fidelity credit insights. So we'll get into more details of what products fall under here, but it's really critical to understand that risk fidelity piece. The second component goes into the identity and fraud confidence. Now, before asking whether somebody is a good borrower, we have to know whether they're the right person. Synthetic identities, account takeovers, first party fraud, AI based deception, they're all fundamentally changing the threat landscape, right? The portion of your total losses that were attributed to fraud or one of these categories used to be a lot lower 10 to 15 years ago, but now they are contributing to a meaningful chunk of the bottom line losses you take. That's why strong identity confidence is extremely critical while minimizing friction or setting up appropriate friction, I should say, for trusted consumers, right? The third component, and probably equally, if not even more important, is the capacity piece. A lot of times we look at a decision on as it stands today. We don't look at the sustainability piece. So this is the part where we bring in the decision confidence, not only as you decide today, but look at the likelihood of this decision being sustainable over an extended period of time, right? So consumers' financial lives are changing faster than traditional credit attributes can keep up. So understanding their current capacity, especially the ability to absorb new debt obligation while maintaining financial resilience, is extremely, extremely critical. The real opportunity, as we see it, isn't optimizing just one of these decisions. It's combining them into a single holistic decision framework. Now, just as an example, right? Imagine approving a consumer who had a strong repayment potential, high identity confidence, and sufficient financial capacity in lieu of identifying a situation where somebody has a strong distinct credit, but it's offset by elevated risk, or where the identity is verified, but the capacity is extremely stretched and the consumer is already over leveraged. So you want to make that integrated view decision, because even one of these components not being right can significantly modify the expectations you have from that for that business or for that P&L. So that that integrated view basically allows the organization to reduce losses, improve approval rates, and enhance customer experience while managing responsible and prudent lending. Right. So looking ahead, AI will continue to make fraud more convincing, but consumers will continue to expect real-time decisions. So the winning institutions won't be those who come up with the best individual models. We want to make sure there's an orchestration where you can holistically look at credit risk, identity confidence, and capacity procession together to make the best outcome, not only for your institution, but also for the consumer. So let me show you real quick how these capabilities are organized into modular sections. So we talked about what these components look at, but we wanted to get a little bit into what are the components which make this effective, right? And then we're going to talk about the deployment piece, because how can you easily consume this in your native workflow? So what makes risk decision intelligence so powerful is that it's not a rigid pre-packaged monolith in saying that, oh, you have to just do this or that. These are modular FCRA compliant adverse actionable solutions that you can bring in. And the best part is we're integrating them into your existing tech stack through partners like MeridianLink. And we'll get into that with Matt later today. But we're really excited to make sure that it's not only building good solutions, but it's consuming good solutions to truly influence the outcomes. So just an example, on the credit risk fidelity side, right, you see Vantage Score, both 4 and 5. 5 is just released, but their Vantage Score 4 is available through MeridianLink, which often acts as your generic anchor score in the industry, right? And is a great baseline score to ensure that you understand the odds of a consumer going bad. But what Equifax has done is we built one score on top of it. So one score takes the core credit, but all brings in all the differentiated alternative data like telecom and utility payments to basically score up to 76 million consumers who would traditionally be considered credit invisible. So you don't have to sift through crazy amount of data and thousands of attributes. You can look at a base anchor score, and you can bring in options like one score to look at that risk fidelity on the consumer. Now, the credit abuse you'll see is mentioned both on the risk fidelity side as well as on the identity confidence side. Now, credit abuse score is the latest score that Equifax has developed, which is to identify ill intent or early delinquency. So your first party fraud. But it's the only adverse actionable first party fraud available. So you can actually decline a consumer if you suspect them to be a high first party fraud risk. That's very, very critical from an efficiency perspective, because you don't have to put more resources on manual review and routing. But a lot of institutions debate whether early delinquency or first party abuse is core credit risk or fraud risk. So you see it there. And lastly, giving examples on the capacity and precision side, we have the latest consumer affordability view offering. And now this is very critical, because this looks at not only whether the consumer is likely to go bad or not, it looks at how much debt can a consumer confidently pay back without being over leveraged. So it's a forecast for the next 24 months in saying that if you were to give Puddy $400 additional exposure, he can easily pay it back, or he would be comfortable paying it back. But if you put a $4,000 debt burden on him, he might not be able to take care of that debt. So again, critical component. And then you have model incomes and the golden standard of actual verified income and employment. But gives you an idea on how we're creating this ecosystem of bringing all these together. But with that, I'll hand it back to David to kick off our panel discussion.
Thanks, Puddy. I appreciate it. And as I said, it seems like, look, I'm fortunate enough to chat with you on a regular basis, and every time I chat with you, I'm learning something new, learning something different. I have to admit, I chuckled a little bit when I saw that last polling question and everybody's like all the above. Because I don't know about you, like even as recent as like a year ago, I don't remember having these conversations around like the integrated credit risk, capacity, fraud. Like everybody was kind of talking about these things, but bringing them all together. And I guess I might attribute it a little bit to the first polling question of these emerging trends, all these things are almost pushing us all this direction. So it seems like we're going a good direction at this point.
Yep, yep. And again, all the institutions have made these decisions all along, but having that collective view has become, to your point, David, lot more relevant and almost a mandate.
Yeah, I love this stuff. Again, it's I really enjoy the chats just as much learning for myself, educating myself as we kind of go through it. But let's go ahead and make a little bit of a shift here. We want to as Puddy mentioned, we're going to get into the panel discussion here. We got Matt joining us. Matt, again, thank you for joining us. Matt Green, Senior Director of Partner Business Development at MeridianLink. I know you talk to a lot of customers just like Puddy does, and so again, I appreciate you chatting with us and joining us today.
Yeah, it's a pleasure to be here. Thanks, David.
Outstanding. Well, I'll tell you what, before we jump into it, though, we're going to do one more polling question because we're going to set up our conversation a little bit. Thank you, Jayla. I appreciate it. If everybody wouldn't mind taking a quick second, what is your biggest challenge to adoption? Integration with connector, compliance issues. I always love compliance issues. That's one of those that always, it's like you got to have the credit, got to have the fraud, but compliance is always a fun one, or friction as we talk about that. People, resource constraints, capital, dollars and cents are always a big one. People are always a big one. Jayla, when it slows down, if you want to throw up the results or give it another quick second, whatever works for you. But let's see where we're at real quick. I'm interested in this one. This should be a fun one. No one's answered yet. Uh-oh. Let's give everybody another quick second. That's okay. We'll do it. Actually, while we're doing this too, by the way, maybe folks are asking questions. If you do have questions, we've already had a couple pop up. Use the Q&A pod at the bottom of your screen to fill that in. But Jayla, do we have a few responses now? Can we throw up the results? There we go. Let's see what it is. Oh, that's interesting. Actually, that's a pretty good mix. People, compliance, dollars and cents, integration. Matt, I don't know about you. I'm a little surprised by that. I thought one of those might pop up like capital expense or maybe even people. But that's a pretty good balance between all of them. Did that one surprise you at all?
Actually, not so much. I'm glad that the connector integrations isn't like the overwhelming winner there, but um, no, I think this is largely a multivariable problem, right? So and a problem that continually adds more variables to the to the equation, right? So for that mix to be pretty evenly split, I'm not overly surprised by that, and I think if we were to repoll them again and give them an all of the above answer, similar
Yeah.
to our other poll question, I bet you that would have been the overwhelming winner.
You're probably right. I guess it kind of goes back to the whole emerging trends kind of concept. Like when you've got so much stuff that's shifting and moving a little bit, it's not unusual that you'll kind of see a little bit all the above. I would agree with you though. It's probably a good thing we didn't see connector as being the biggest challenge from that standpoint. But actually, why don't we kind of let's start there because there seems to be a little bit of a growing trend in part of the conversation, and maybe we can talk a little bit about the economic environment, what's going on, what's creating that blind spot. Because I know, and I mentioned before, like Puddy talks to customers, talks to prospects all the time. At MeridianLink, you guys have your own loan origination system. You're working with
Correct.
lenders all the time.
Hmm.
In many cases, a lot of those things that Puddy was talking about earlier are already fully integrated from a customer standpoint. So, like, I guess here's the thing. Here's what I'm interested in. Thinking about all of that, looking at all of that, like how do those things or how do lenders get to the point where they're able to kind of look at, hey, these folks are credit worthy and these folks are maybe not quite, within that integration and that process. Like, are you seeing certain things that stand out, or is it like, how do we get rid of those blind spots? What's popping for you guys?
Yeah, it's a good question. I mean, I think again, the equation becomes more and more complex as time goes on. One of the things that I had really appreciated about Puddy's part of the presentation here was the focus on the emerging trends and the macro pressures, right? Which again, in the poll question were the top two responses about things that our mutual customers are dealing with. I think that one of the emerging trends that we're starting to see, right? And again, Putty mentioned this, is the number of what we might call thin file or credit invisible consumers, right? We have a responsibility as those who work with and serve our communities and their community lenders like credit unions and community banking institutions to find a way to help every member of the community, not just those that are, very clear, easy approvals, right? And so when it comes to those populations that are thin file, no file, or don't necessarily fit our traditional, credit underwriting guidelines or practices, it's those additional signals that really make the difference, right? And so that's where something like a one score from Equifax, or really the ability to start looking at these alternative ability to pay attributes, telco, subscription payments, utility payments, rental payments, right? You may have a borrower in front of you who's perfectly capable of fulfilling the obligation related to that loan, but if you're not looking at those type of signals, right? And a borrower walks through the door, you pull a credit report and a Vantage score on them, and Vantage score is pretty good, right? In that thin file population segment, but if they don't have enough history to generate a score that suggests by our more traditional methods that they're a good borrower, it's going to become much more difficult or much more frictionful, let's say, to curate that applicant, that borrower through the origination journey. And so if you're able to layer in those additional signals, like a one score from Equifax, it gives you a broader picture of ability to pay. That I think, in my opinion, that's what really helps solve for that problem and open up that lending world to borrower from our shared customers for those borrowers that might not be your historical typical good applicant.
Yeah, I think you said the magic word, Matt, because as you were saying that, I remember a couple of conversations with customers, and it's that scary thing because it's like you start talking about this data layer and you start talking about that data layer, and there's like a look of panic on their face, or on people's faces, like, oh my God, okay, this is way too many layers. We're creating too much friction, exactly as you said. It's like, because our customers are trying to grow. And if you create, like, I guess there's this perception that if you create too many data layers, if you're doing too much stuff, that you're going to slow down the process, and all of a sudden you're going to lose people and they're going to kind of go off another direction. Like, are the additional data layers creating that friction, or is there ways to get past that? I think some of our customers have started to kind of, and we've been working with customers to kind of create that seamless experience. But like, what's the secret sauce on your side? Are you seeing that too?
Yeah, well, it's certainly the concern, right? That the more information that we ingest as part of our workflow, the more friction we may introduce into the borrower experience. It's certainly a valid concern, right? But I think that's where Equifax and MeridianLink, the partnership we share in the shared mission of trying to improve that for our customers, comes to light, right? So at the end of the day, and not to over abuse this saying, but it really is a complex equation that we're trying to solve for here, right? There's traditional borrowers and non-traditional borrowers could be of equal viability in terms of as an applicant to our FI, but we don't necessarily, if we're not looking at this picture more holistically, we don't necessarily have all the things we need in order to treat them equally, right? And so that's where it's incumbent on Equifax as a data provider and MeridianLink as a loan origination software to curate an experience that allows for the easy ingestion of these additional signals that help us solve for those non-traditional or maybe non-typical scenarios, but still allow for the proper evaluation of the borrower from both a credit risk, a fraud risk, and a capacity perspective. And so I think at the end of the day, what's really, really important is the availability of those signals from an Equifax, the ability to ingest and leverage those signals in decisioning from, from a MeridianLink or a connector perspective. And then from the financial institution side of things, it's working with both us as the technology partner, Equifax as the data partner to optimize the decisioning policy to use those signals so that we can curate that customer from application to funding with as minimal friction as possible, even though we are looking and using a lot more signals than perhaps we're normally or we have historically.
Okay.
Yeah. Yeah. And
Yeah.
David, I'd add on to that, right? Exactly what Matt said. And then why we love these partnerships also is like these layers are critical to a better decision. The Equifax's motto is help a consumer live their financial best, right? So we have an obligation as a custodian of all this data to make sure it is being put to the right use cases, right? So what we see in practice is adopting these layers doesn't slow the workflow down. It actually accelerates it, right? Instead of loan officers pausing to manually review documents, chase down pay stubs, or flag suspicious file, now all this data is pulled instantly because it's integrated into systems like MeridianLink, and it can be a part of the native workflow that our institutions are using, financial institutions are using. So I would argue that even though bringing in more data layers seems scary, it actually accelerates the workflow versus slowing it down.
Interesting. Okay, so I was actually debating whether or not to save this to the end, but I think this is a perfect time. There was a question that came in. I want to put this out there, and I'm going to paraphrase this a little bit because I think I know where they're going. The question was, is it important to have an integrated or unified fraud verification, credit risk decisioning, and capacity decision? Does it need to happen all at the same time? Can it be separate steps? Like Puddy, you just mentioned, I'll let you answer first. You just mentioned that it accelerates the process. Is it looking at them all together, or is it like step one, step two, step three, having that integrated view? Like, do you have an opinion on that?
Yeah, I mean, yeah, that's why we were talking about RDI, right? That's the
Okay.
whole context behind it. That these decisions are made. All of the entities have to make these decisions, but treating a fraud or a credit risk as an isolated silo just
Yeah.
creates friction, right, for legitimate applicants. And it leaves gaps in your process flow. So a unified view or an architecture helps you look at, again, the holistic approach as well. I'll give you an example, right? I was having this conversation. This is probably about a year and a half ago, and somebody was looking at synthetic identities. Synthetic identities have a average credit score of 750. Now that person went bad and their average score is 750. So this institution was really struggling that what is it that we cannot detect through our risk models? And they were going down a path of building custom risk models. But the idea was, no, it's not a risk problem which you're trying to solve with a risk score. It's a fraud problem. So this integrated view becomes very, very critical. And not only from as I said, from a predictability perspective, but also from a consumer experience and profitability and your obligation to make the right decision for the right consumer's perspective.
No, I can totally see that. And Matt, I'd love to get your opinion on it as well, because like you were talking about, as you were talking about the signals, all these different signals are coming in at you and telling you something a little bit different or something different about each. Like, is it the same kind of thing that you're seeing on the connector side? Are they looking at these signals together and as a part of a unified decision, or are they going through that process? What are you seeing?
Yeah, I would say think about it in terms of like orchestration, right? You're gonna access all of these signals as part of one workflow, or you should.
Yeah.
You might not be, say, pulling all of those signals at the exact same time, right? But you're going to evaluate those signals as part of one flow. And in terms of actual time passed, it can really seem like it's all seamless. But
Yeah.
I think to Puddy's point, and of course he's the PhD in this conversation, and I'm the guy who's about to graduate high school, right? But I think that there are going to be situations where you may determine you need certain signals, and you may determine that you don't. It's all about policy, right? But the goal is to have the availability of those signals in the scenarios where you deem them appropriate, right? And so I like to think about work number in that conversation, right? There's going to be scenarios where just based upon the loan type or the loan principal balance, like you may or may not opt to acquire the work number product, but for the scenarios where you need it because of a risk evaluation or the product itself, it's available to you and it can be ordered automatically, right? And you can verify income automatically, right?
Yeah.
I think it's really important to be able to assess those intentions behind the application in addition to the credit risk, all within one, seamless orchestrated workflow.
Yeah, no, I think that's a great point because it's not it, it's it, it's the orchestration and the process because we don't want it to be siloed. Like siloed is bad,
Right.
but working through the process, working through the signals that that we've started talking about it is we kind of have mentioned it already is risk decision intelligence, having the right signals at the right time to make the right decision. Like even the example that was just given a little bit ago is if you're getting a right signal and you're trying to make a credit decision, but really it's the signal's about fraud. It's making sure you have the availability of that stuff at the right time as you're kind of working through it. I guess there's no question we all had access to a lot of data. We got access to a lot of solutions. The other thing that we always face, we talked about friction. One of the things that we always face that is almost always the next step is that whole compliance conversation. FCRA, even Puddy mentioned earlier, FCRA compliance, adverse actionable data, and things like that. Just out of curiosity, it's of all the data pieces that we've kind of been talking about, is there some that really stand out or some that customers have been asking for more than others? Like is it credit capacity or cash flow that's kind of coming up more? Is it like the work number example that you just gave? Is it fraud? Is it kind of, I guess maybe I should put up another polling question here. Is it all the above?
Yeah, from my lens, right, and for MeridianLink, I own the responsibility for our bureau partner relationships, and then fraud is one of the other categories that I manage for the business.
Okay.
And I would say one of the things that I've seen become more prevalent in a lot of the customer conversations our teams are having is kind of those first party fraud intentional behavior signals as part of the origination workflow. So I think historically, right, we do a fraud evaluation when the member enters the door for the first time, opens a deposit account. Sensible, logical, right? But if that member enters today and they come back in 6 months for their first loan product, we're not necessarily doing a comprehensive fraud evaluation at that time, right? And again, one of the areas now that we're starting to see pick up is that first party fraud, that kind of what is the intention behind this application? Not just are they qualified, but do they actually intend to repay this? There's the synthetic element to it that Puddy covered earlier, but then there's also, I might walk through the door, Mac Green, I've got a good credit risk profile. But given some of the macroeconomic conditions that we're facing, I might be coming in for a credit card and with no intention of ever actually repaying it, right? Something to that effect. And that's where I think these additional signals like the credit abuse model, affordability, and like those sorts of things are really, really helpful in that evaluation. And so the ability to adverse action off of first party fraud signals, I think is something that at MeridianLink, we're starting to see more and more demand for. And I think it's really relevant for the time we're in just because of some of those macroeconomic conditions.
Yeah.
Yeah,
Well,
and I'll add one thing to it, David, because
Please.
this is critical, right? When you're looking at multidimensional view of a consumer, to look at a true financial profile, as Matt was talking about, there's layers to why this is critical, right? Like the first layer, the way I see it from a client's perspective, is you protect your business, right? Your real-time fraud and capacity data is critical before the risk actually hits your book. So that's the very first layer, just protect your business. The second is achieve operational efficiency. Now, and this is very, again, critical to how a consumer feels right when they're building a relationship with you. So when you automate income and employment data and you eliminate friction and you eliminate manual verification, you're also reducing those costly drop-offs in the application flow. So you're getting more efficiency and the application completion rates. And then you get into the profitability piece, right? You can say yes to people whom your competition might not be able to say yes to because they don't have the information and the signals. So you're saying yes to thin files, you're saying yes to credit invisibles, you're maintaining more long-standing relationships because you're first in wallet and the customer lifetime value is a lot bigger. So there's a layered approach on how this helps, both from protecting, from operational efficiency, and from profitability. It goes through the spectrum.
No, I totally get it. Totally get it. And it's actually, I'll tell you what, this is probably a good segue too, because we want to leave some time for questions at the end and we'll shift a little bit. But one of the things that you were just saying there's a couple of questions that popped up. And so I want to ask this now. A question that came directly from a customer as you were talking about capacity as an example and origination. The thing that's interesting about these two things, and I'll ask the question here in a second. Origination, a lot of people I think look at origination as a snapshot, this one-time view. So here's the question. As people are looking at, does debt capacity forecasting process account, does it account for both the debt capacity at the point of origination as well as whether or not it will remain adequate throughout the life of the loan? Like, is there longevity in that view and that look, or is it really just a snapshot and people have to constantly be looking at and evaluating that as they go along?
That's an excellent question, and thank you for to whosoever sent it. Right, so this is again. Let's go back to COVID days. A lot of people were talking about, oh, the scores are inflated. They're not necessarily reflecting the true risk, and my odds are not coming out right. Why was that statement made? Because the capacity of the consumer, because of the elevation of savings was very different. So there were other signals from a capacity perspective that you were looking at. Now, coming out of COVID, it was the complete opposite. The additional savings had depleted and people were a lot more constrained, and everybody was talking about the sustainability or financial resilience of a consumer. So you want to have the confidence that if a consumer is going to have stress, whether it's going to be short-term stress or sustained stress. So that's why this capacity piece comes in very critical. So when we built consumer affordability view, it looks at that 24-month window. It doesn't look at just a point in time window. And it says that, okay, what is the debt that this consumer is most likely be comfortable paying over a 24-month period? So yes, this is a big lesson learned coming out of COVID, that things like affordability and financial resilience absolutely have to be a part of your decision, because they're giving you a longer view of that decision confidence and sustainability of that decision.
Okay. Now, and Matt, by the way, correct me if I'm wrong, but like, I'm going to go back to the signals question. Your LOS, like I think what Puddy, you're referring to, I think the credit abuse component or the credit abuse risk rating. But again, Matt, correct me if I'm wrong. You've got those signals in your platform already as well, like that, the current and future view, right?
Correct. We MeridianLink Equifax, we partnered and recently brought to market through MeridianLink the credit abuse model, the consumer affordability model, the consumer income view plus model, and we'll be working together to bring to market both Vantage Score 5 and the synthetic ID model in the near future.
Okay, perfect. And I figured that was the case. I guess one of the nice parts about a good partnership, we can deliver it to you. Connector, we got some good stuff on our side. I want to keep the Q&A stuff going too, because there was another question that popped up. We're talking a little bit about credit capacity. I think this is worthwhile. And Matt, I'm going to start with you on this one, because
Sure.
you mentioned you've got some fraud, you own the fraud piece on your side. But so I'm going to read it word for word. What measures are FIs taking to verify social security numbers that have no history and are fraudulent versus those that are maybe legit but have little to no history? Like, how are you guys looking at that in a certain way? And Puddy, I'll let you jump in as well. I think that's a hard question to answer. It's like, how do you check a social security number that's truly fraud, made up, maybe using AI, synthetic ID, versus this is legit, but these people, thin file, no file. Like, I think you mentioned that earlier too. So I don't know. What are your thoughts?
I can take a stab at it, Matt.
Go ahead.
As long as you. This is an interesting one, right? So from an Equifax perspective, when we invest in so much data, it's also setting up the processes to look at similar problems, David. So again, thank you for whosoever submitted the question. That's a very compelling question. So when you're trying to tell a legitimate thin file consumer, right, apart from let's say a synthetic identity, the first step is usually verifying the SSN, name and date of birth, directly with the Social Security Administration. You go to the SSA, but then from there, Equifax layers on a lot more identity proofing data and alternative data intelligence using tools like synthetic identity risk that we have. Now, this solution checks the address data to flag if there's commercial mail drops or vacant properties. It cross-references phone careers. It looks at utility records. We can get into liveness and biometric scans and physical ID scans. So a synthetic fraudster might be able to hide behind a SSN check for a little while. But when you tier in these other things of cross-referencing phone careers and commercial mail drops and address checks, that deeper verification and real-time behavioral signals, it's very difficult to escape those.
Well, like that, the behavioral signals have definitely popped up more and more. Matt, I'll let you chime in as well. You can have the last word on that one.
Well, I think we're back to the whole PhD versus high school education situation here, but no, I mean, I think he's right. It's the ingestion of signals, right? So you want to be able to see the correlation between all of the identity elements, not just the SSN, right? So is that name and address correlated to that social security number? Does the date of birth align with when that social security number was, administered by the SSA? Those sorts of things. So if you have a kind of a consortium view, let's say, of all the identity elements and how they tie together and their history and any ties that one particular element might have to a fraudulent application or synthetic ID, something to that effect, which many of the solutions offered do that type of evaluation, right? A lot of the fraud products out there. That should solve for, the majority of the cases where you have a identity that could look perfectly legitimate but isn't.
Yeah. Well, and I'll go back to one of the things we said earlier. That AI component is it's so crazy. I was talking to a fraud expert the other day, and it blows me away that the ability for a fraudster to go out and leverage AI, create histories of tax returns and information on an individual, and have it look totally legitimate and be completely fake, across the board.
Yeah.
Like, it's going to be a challenge.
Yeah, but that's where, like, even solutions like Work Number, David, sorry, I'm adding another point there, but that Work Number is very critical because it's a direct employment record. It's verified. It's not coming in through the consumer. So when we talk about layers of data and signals, that's where things like Work Number become very handy because it's direct employer verified information. You're not coming up with that middleman where somebody can fabricate it. So you just keep stacking on depending on the problem.
Gosh, you would think that we came up with this and planned this whole thing, data layers, efficiency. My gosh, it's perfect. I don't see why anybody wouldn't jump in, right? No, thank you guys. I appreciate it. And actually that was the last question of the day. And I know we've got about 5 minutes left. So why don't we do a little bit of wrap up? We're gonna kind of jump back over to the deck here for a couple of seconds. Obviously, thank you all for joining us today. We really do appreciate the time. We hope you enjoyed the conversation, got some good information about what's going on in the marketplace, some of the emerging trends, how people are approaching an FI. Here at Equifax, we would love to work with you. Obviously, we've got the solutions. We're very proud of our solutions. We're very proud of our relationships and partnerships with folks like Matt and MeridianLink, and the Connector View. If there's a few things that we can bring to the table, and we'd love to help you out. First off, with the experts, we got a lot of experts. You hear them on today's call. We're here to help you pick and choose what's going to be best for you. If it's Work Number, great. If it's Vantage, great. If it's synthetic, great. OneScore, we've got all those things in that risk decision intelligence view, being able to make better decisions. Easy integration, always a big factor. Again, I'll go back to the polling question. Thank goodness that connection was not the low end of it. But having And one of the great parts about a connector partner like MeridianLink, that integration is already there and you can leverage those solutions. We've got other integrations on our side at Equifax, but when it comes down to it, for us, the future proof is one partner, three core capabilities. Working with Equifax, we have that intelligence, we have that data, we have that experience. You can come and work with us. You can start layering those things in, and guess what? If you need another layer down the line, we got it for you. This is something that we're working very diligently on, something we're constantly looking to improve upon, not just a flash in the pan or a one-time scenario where it's not going to get better. We believe this is where we need to be going. Risk decision intelligence, those emerging trends, all of those things. Again, we would love to be able to help you out with that. And for those of you that are interested, we'll go to the next slide here. There's a nice little QR code. We're going to make it super easy for you. If you want to click the code, we'd be happy to reach out to you. Raise your hand. Just let us know. Again, anything we can do to help you out, we'd love to work with you. And look, keep an eye out for future meetings, future webinars like this. Many of you, I'm sure, have been on our Market Pulse webinars, talk a lot about credit trends and things of that nature, but we're getting a lot of questions from folks like yourself to drill down on some areas, just like risk decision intelligence, which is why we're here today. So that being said, thank you again. On behalf of Equifax, Matt, we again appreciate you and MeridianLink joining us today. We hopefully be able to get to do it again in the future. And for everybody else, have a great day, have a great weekend, and we'll catch you on the flip side.
Thank you, David.
See y'all.